It's an interesting trade because it doesn't follow the typical mean reversion setup that I usually use. If you remember, I take different kinds of trades in my group. So my main bread and butter trade is the mean reversion setup that is described in my book, but I do take other kinds of trades, so post earning trades, support and resistance trades, TTM squeeze trade. It's a bear put spread. Symbol is CI, which is Cigna. The trade structure is 325 320 put spread. So I'm buying the 325 put, selling the 320 put at the same time to create this trade structure. Now, sector is healthcare, expiration is 719. Trade type, that's where I mentioned the kind of trade that I'm taking. In this case, it's TTM squeeze. So, and cost is 250 because it's a $5 wide spread, and potential profit is also 250. As you know that all my trades, when they are successful, they have the potential of doubling their money. Of course, I do close my trades at 94% profit target. I don't wait for 100% because to avoid assignment and exercise on options. So now if you look at the notes on this trade, so number 3, reasons to take the trade. I'll always remind you that whenever I take a trade, there is nothing special about me taking a trade. Just because I took a trade doesn't mean that it's going to be successful. So at that point of time when I'm taking a trade, it makes sense to me, so I will take the trade. But there could always be, the stock market is a two-sided market. So just because I'm lacking the trade, somebody else is actually taking the opposite position, which is what makes that's how you get a fill on your trade. So I'll give you conflicting reasons so that you can analyze the trade that I have just taken and decide based on your risk tolerance, your own technical analysis, whether that trade is suitable or not. So coming back to number 3, which is reasons to take the trade, I've mentioned that healthcare sector is looking horrible. Take a look at XLV. XLV is the ETF that follows healthcare. Although this is a setup based on TTM squeeze, the chart on CI is full on bearish and XLV is giving the same signals. So what I've mentioned in this, the reasons to take the trade is that it's based on TTM squeeze. So usually if I take any trade on TTM squeeze, my regular mean reversion indicators will not confirm that trade because it's based on completely different setup. So the RSI, the DMI, all those things may not agree because it's purely taken on a TTM squeeze setup. But in this particular case, I've also mentioned that although I'm taking it on TTM squeeze, the chart on CI is full on bearish. And XLV is giving the same signals too. So XLV is the healthcare sector. Obviously, you know my trading style. I do pay attention to the whole concept of a rising tide lifts all boats. So XLV is the tide, the healthcare entire sector, and CI is just a boat on that sector. So if XLV is looking bearish, then CI is most likely to follow that trend. Now, reasons to avoid the trade. So I have mentioned that jobs report on Friday will move markets again. So as you know, we are living in a inflation obsessed environment, and we keep getting these macroeconomic data releases every week. It can happen like anywhere from 1 to 4 times a week, and markets are like hyper focused on these data points. So last week was full of jobs report. There was ADP jobs report. There was unemployment numbers. So anytime we have that kind of data coming out, it doesn't matter how good your technical setup looks like, because that particular data on that day will change market direction. So you just have to always be careful about that. And that is the reason why For the last 2 years, I've been trading at between 10 to 15% of my portfolio because of the unpredictability in the markets due to the inflation obsessed environment we are living in. So reasons to avoid the trade: jobs report on Friday will move markets again. So it doesn't matter if this trade was looking good, it could just reverse the direction and go against you. Okay, so this is a chart of CI, which is Cigna again. And the setup looks like this. So at the bottom, I have this indicator called TTM Squeeze, which is a free indicator available on most of the platforms. They do sell a pro version of this, and I do have that version too, called TTM Squeeze Pro. I personally wouldn't recommend you spending any kind of money buying that indicator, because I don't think it adds any extra value to the free indicator. The indicator, and it's very expensive. The indicator costs like $700. So there you go. So the way the TTM Squeeze indicator works is, it's actually just another visual representation of Bollinger Bands and Keltner channels combined. And as you know, I've described in my book that I do use Bollinger Bands and Keltner channels all the time. So the way I use them is, if you look at the top part of the chart, the green line and the red line are the Bollinger Bands, the gray lines are the Keltner channels. And the way I use it is, when the Bollinger Bands are trapped inside the Keltner channels. So this is one incident where that has happened, and again this is another incident. So when that happens, the stock is entering a low volatility period, and that means there will be, do not expect any kind of reliable upside or downside movement until the stock is trapped in that consolidation phase. So this is a very bad setup for a swing trader, because for a swing trader, you are trying to spot the tops and bottoms, and you are basically betting on the stock reversing and going in that other direction. Now with when the Bollinger Bands are trapped inside the Keltner channels, the price movement is so little that you will keep getting chopped out. Your trade will not become profitable, and you can see that. So in this particular case, look at the price movement just chopping around and just going sideways. So that's how I use it. But the TTM Squeeze indicator is actually very interesting. So what it does is, when a stock is entering that, when the Bollinger Bands are entering Keltner channels, it will start plotting these red dots. And what that means is that, and if you just correlate that to the chart, the moment the red dot appears, the Bollinger Bands have entered the Keltner channel. So it's straightforward. So the way it works is, creator of this indicator, the way he uses it is that, as long as the red dots keep showing up, you don't take any trade on the particular stock. You will take a trade when the red dots start becoming green, and you would take a trade based on the direction in which the squeeze is firing. So the problem with, the reason why I don't take these trades is because once the stock goes into this sideways movement, you have no idea whether the stock will explode out of this consolidation phase to the upside or downside. So you don't know that. So taking any kind of directional bets is meaningless. Now what this indicator attempts to do, I'll just use the word attempts because it does come with lots of false positives. And an example of that is a trade I took on Amazon on this indicator, and that actually went against me. So it does come with false positives. All indicators come with false positives. So what it does is, once the red dots turn green, you have to pay attention to these bars and see which way the bars are firing. So if you see light blue bars, that means the squeeze is firing to the upside. So that means you need to take a bullish position in this particular stock. If the bars are firing to the downside, then you would take a bearish position. So that is what I did for this particular trade. Now let's go back to the day I took that trade. So this is the day. So the stock was trapped in a squeeze from almost a month now, like, so from June 11th until now, 3 weeks. Stock went into a squeeze, which is the red dots, and it's just chopping around in a very small trading range. Now at this point we see the first green dot, and look at the bar. The bar is actually firing to the downside, the red bar. So you could wait for confirmation. So you could wait for, if you read about this indicator, it says that wait for at least 2 or 3 green dots and bars before you jump into a trade. So I actually took, the trade I took was on the first green bar, because what I also saw was that RSI was dropping rapidly. Trend is bearish. So I took this trade on this day. Now let's switch back to today. We just have 2 green dots and the bars are increasing in size. So the way this indicator works is, if once you start seeing the red bars fire, in this case, the stock is expected to continue going down until you see the first yellow bar. So like an example is here. So that is when this downtrend is over, and then you should either consider getting out of your bearish positions, or you could also take on a bullish position. Same thing on the upside too. So in this example, the bars start firing on the upside, the light blue bars, and then you can keep riding that trade until the first dark blue bar appears. That is when this upward movement is over, and you can see that the stock actually dropped after that. So that's this trade. Very interesting setup. Most people that use this setup are naked call buyers, because my trade structure is a debit spread, so you can never make more than double your money on my trade. So somebody who's into buying naked calls could benefit from this trade when it plays out. So if you get into this trade at the right time and you keep riding that wave up or down, doesn't matter, naked call or naked puts, you could actually make a lot of money. So just throwing this out there, it's a very interesting setup. I would encourage all of you to try it out. Let me know how it works for you.